U.S. controls the monetary base by making purchases or by selling assets. Okay. So if the Federal Reserve wants to increase monetary base, they just go out and buy a bunch of treasury instruments, bonds and bills. They pay for those by increasing the reserve account of the relevant commercial bank that's involved in that transaction. Okay? So ultimately, the Fed's conduct of what is called open market operations, the buying and selling of treasury instruments, that determines monetary base. Monetary base determines the money supply determines the price level. Okay? So that was the story from last week. Then I went off and I talked to you about why the Federal Reserve exists and how it, and now I'm going to talk to you a little bit about how it's structured. Okay? So the interesting, I guess, the history lesson here that's worth telling is that actually the Federal Reserve was not created in order to control the money supply and hence control the price level. The Federal Reserve was created in 1913 in response to the panic of 1907. What the Federal Reserve was intended to do by its initial creators, now over 100 years ago, was simply to provide kind of emergency liquidity to the banking system. What the people who thought about all this imagined 103 years ago was not that we would create an institution which controlled monetary base and hence controlled price levels. They just thought what we were doing was creating a kind of an emergency relief valve for the banking system. Okay? It didn't quite work out that way. And because the Fed pretty quickly discovered it had this kind of power, the structure of the Federal Reserve was shaped in such a way as to try and put some, I guess the best way, just to use the word, checks and balances on what the Federal Reserve does. So what I want to talk about next isn't really macroeconomics per se, but it's really critical to understand. What I want to talk about next is essentially the politics of the Federal Reserve System and why it does what it does and how it exists the way that it exists. Okay, so here's the thing about the Federal Reserve. The United States, and this is kind of unique, but not entirely unique to the U.S., a great deal of the power of the Federal Reserve System is centered in Washington in what's referred to as the Board of Governors of the Federal Reserve. Okay, and this is kind of a unique structure. The Board of Governors of the Fed, there's 7 of them, all right? They are big shots, right? They're appointed by the President and confirmed by the Senate. So they have sort of the same status, if you will, of major officers, cabinet members, judges, that kind of thing. Okay? Appointed by the President, confirmed by the Senate. However, their terms of office are quite long, 14 years. Okay? And they are not allowed to be reappointed after their 14-year term. Now, it turns out that if someone is appointed to take over a board position in the middle of someone else's term, so if a board member dies or retires in the middle of his term, then the newly appointed, the replacement board member can serve out that term, plus could be reappointed for a 14-year term. Okay? Now, there is something kind of magical about the number 14. Does anybody want to guess what's magical about the number 14?
Is that what?
It's staggered.
Yeah, it's not divisible by 3, or 4, excuse me. All right? So what we have is the members of the Board of Governors, their appointments are staggered, and to be off essentially off presidential cycle, so that any president will have an opportunity to replace a portion, but not the entire membership of the Board of Governors. And again, what I want you to see, the story that I'm telling you is one in which the institution is designed to insulate it from political pressure. Okay. The other thing that's it's hard to describe. I'll just make the point. The chairman of the Board of Governors. So this is Janet Yellen, Ben Bernanke. The chairman of the Board of Governors is appointed just for a 4-year term, and may be reappointed as often as the president chooses to reappoint the chairman. Okay? So the chairman, it really is much more directly responsible, or should be responsive to the political forces at hand. If you're wondering, Janet Yellen is in the middle of her first term, so she has 2 more years before President Trump has to decide whether to reappoint her or not. The president cannot officially demand, or he can do anything, but he can't force the resignation of the chairman of the Board of Governors. I was at an event the other night down at the Dallas Fed, and ended up chit-chatting with some guys who work for the bank, and we talked about this though, and they said, yeah, he can't make her resign, but it would be very hard if President Trump was very publicly critical of Janet Yellen. It would be hard for her to remain in office, which isn't to say that she wouldn't stick it out. It would just be harder for her to do it if she was under assault by the president. I mean, I don't mean that literally, only with this president. But you had a question.
Oh, that's actually
okay. Okay. So again, I'm just kind of going through the Washington side of it. This is kind of hard to quantify, but it's true. There is developed, and this has been both Republican and Democrat for a very long time, kind of a tradition that this is a non-political thing. So presidents have tended to select sort of, shall we say, high prestige professional people, both to the Board of Governors and to the, especially to the chairman of the Board of Governors. So if you look at Ben Bernanke, he was very, very well respected professor at Princeton. Written a lot of important papers, as it turns out, on the Great Depression. Janet Yellen, another academic, very, very respectable academic career, no real involvement, as far as I can tell, in politics. It's also the case that presidents will appoint people whose ideology may be very different from their own. Alan Greenspan is a good example of this. Alan Greenspan's sort of his political philosophy, which I guess you call fairly hardcore libertarian, was not consistent with several of the presidents who appointed him. Yet he was reappointed, 4 times in his career. So again, there's kind of this tradition of apolitical appointments.
Where's Paul Volcker?
Again, Paul Volcker is the same. He wasn't a hardcore academic and neither was Alan Greenspan, really, like Bernanke and Yellen, but he had a big reputation as sort of a wise man, and so he was appointed. David?
You mentioned they're non-partisan appointments. Are there specific political methodologies in which Republicans would want to do something from a monetary policy perspective and Democrats do something?
Yeah, it's a little bit hard to say because frankly most presidents aren't, monetary policy is not something they understand very well. In general, probably Republicans tend to appoint people who are more going to be more concerned about price stability and stability of the financial system. They say Republicans are going to appoint those kind of people. Democrats are more likely, I think, on the margin to appoint people who are more willing to do policies that would increase employment. But that's, so I think the fact is that most presidents don't really know much about it, and it'll be interesting to see what Donald Trump has to say. All right, so, but that's only half of the story. In the U.S., we have the Board of Governors who are centered in Washington, and then we have these 12 regional district Federal Reserve banks. Okay, so I'll show you a map here in a minute. But the country is just basically divided up into regions. Each of these Federal Reserve banks is a freestanding institution. So we have a Reserve Bank here in Dallas, the Dallas Fed. There is a president of the Dallas Fed, this guy, Robert Kaplan. There is a board of directors of the Dallas Fed. There are shares of stock in the Dallas Fed, although they don't trade and aren't publicly owned. It's a real business. It's a thing. All right. And what do? Well, as I say, there's kind of complicated rules on who owns the regional banks. The Dallas Fed is owned by sort of a combination of commercial banks in the district. Okay. What these Federal Reserve banks do is a couple of very different kinds of things. One thing that the Federal Reserve banks do is just service ordinary needs of the commercial banks in their district. So I told you this last week. Federal Reserve is basically a bank for banks. Commercial banks in the Dallas district have accounts with the Dallas Federal Reserve. Okay? Money changes hands, flows between different commercial banks, and that's just what the Fed does. If you've ever had a chance to go down to the Federal Reserve and take a tour, you'll notice that it is an extremely secure building. They've got all kinds of stuff that they don't let you see in the basement. That's because they are handling, actually a lot of cash flows through that, literally flows through the building every day. But more important than that, there's lots and lots of data that is very, very sensitive and very time critical that flows through the building. And that's what you got to do if you're a bank for banks. Okay? So that's part of what the district banks do. The other thing that the district banks do is provide input into the decision making of the Board of Governors. So every president of the district bank is they literally go to Washington every 6 weeks for a meeting, but they are in contact with their cohorts on other district banks and with the Washington-based Board of Governors on a daily basis. That the district banks provide input into this process of forming monetary policy. Okay. Here's the map of the Federal Reserve districts. As you can see, we're in the 11th district, and that includes part of Louisiana, part of New Mexico, and all of Texas. Okay. This is a schematic, kind of the really critical organization chart, which describes how things are made up. So what we're showing you in this chart is that there's authority that resides in the Board of Governors, the Washington people. There's authority that resides with the district banks. The commercial banks within each district have some control over the Federal Reserve. So there's input going from here to here. But the most important thing to notice here is this column here. the single most important decision-making entity in the Federal Reserve System is the so-called Open Market Committee. It is the Open Market Committee that meets about every 6 weeks and makes decisions on the conduct of monetary policy, which means that they are literally making decisions on how much the Federal Reserve should buy and sell, and hence they're making decisions on the size of the monetary base, the money supply, and price levels. Okay, so this second column here, that's what's really critical. And the makeup is quite, I don't know, I think it's kind of cool and extraordinary. The way it works is this: there's 12 voting members on the FOMC, the Federal Open Market Committee,
Including Janet Yellen?
including the president. All of the members of the Board of Governors, including the president, are permanent voting members on that committee. Okay, so there's 7 of them, and 7 is kind of the magic number, at least as compared to 12. How come that's a magic number? That's a majority right there. The Board of Governors, in principle, can set monetary policy, because the Board of Governors, the Washington side of the FOMC, always has a majority of the votes. But it's a close thing. Okay? There's 5 of the district bank presidents who serve, and they serve on a rotating basis on the Federal Open Market Committee.
So it's kind of arbitrary the way that selection process is done.
Yeah, in the sense
You
that
like rotate on.
because they rotate back and forth. So, example, right now, Robert Kaplan, our district bank president, is not a voting member of FOMC, but he is, if I've got the calendar right, I'm pretty sure I do, he's going to rotate back on to become a voting member after January. Okay? So, so you've got 5 district bank presidents, you've got 7 members of the Board of Governors, and that's the key committee. That's the committee that sets monetary policy. Now, just so you kind of the way it works is about every 6 weeks they meet. Everybody meets in Washington, and all the members of all the presidents of the district banks go to that meeting. Even if they don't vote, they are allowed to sit in and they can speak and so forth. And then they make decisions about what to do for the next few weeks until the next meeting. Yeah.
Okay, I remember hearing about that there's like the right-hand man to Janet Yellen being like the New York, is that
Yes.
the New York Fed president?
President. And
Okay. Does he always stay on, or does he rotate?
no, I think he rotates, but I may be wrong about that. The reason the New York Fed president is sometimes considered the right-hand person of the Board of Governors, there's 2 reasons. One is New York is obviously a financial center, so it's thought that the president of the New York Fed may have some special insights that you can't get if you're in San Francisco or Dallas. The other reason why the president of the New York Fed is particularly important, it's the New York Fed that is charged with the conduct of monetary policy. So if the FOMC gets together and says, okay, we want to increase the monetary base by 2.5% over the course of the next 6 months, the New York Federal Reserve they'll be the ones that literally go out there and buy the Treasury instruments, okay? Because the New York Fed controls the Fed balance sheet, so that makes them just pretty important. Okay, so that's how the system is structured, and again, the idea here is checks and balances. That you have central authority in Washington, their power is checked by the presidents of the regional banks. Okay? All right.
So when people blame things on Yellen, is that accurate, or is she just a spokesman for this committee's decisions?
It kind of depends on the personality of the president. So, for instance, it was widely believed that when Alan Greenspan was president of the Fed, that he dominated the board. That no one would, because he'd been there for a long time, he had a big reputation. To dissent from what the maestro wanted would have been difficult. I'm not sure that Mrs. Yellen has the same, even though she's really smart and has a wonderful reputation, she probably doesn't have that kind of authority that came to Alan Greenspan.
Well, I mean, didn't she have some dissenting votes back in
Yeah.
September?
Yeah, she
Which
definitely
was-
had some dissenting
which
votes.
That's like unheard of. Part of the reason I was in Harvey Rosenblum's class in Mod A, and he was saying that that was unheard of, and a lot of the reason why that is because the way they have it set up, is she'll always vote first, and it's the New York,
Right, got
the right-hand man. So that's already two votes that are, those two
Yeah.
votes are gonna be one way, so it's really hard to dissent.
Yeah.
And it creates just kind of this.
Yeah, but you have to remember the presidents of the district banks are not, they don't really have a problem with self-esteem. So you take our guy, Robert Kaplan, right? He made, God knows, probably more money than I've made at SMU when he was running the investment bank at Goldman Sachs, okay? So he was a big-time investment banker, made, probably hundreds of millions of dollars. Then he went to Harvard and was, what was he, an associate dean or something like that, and was a full endowed professor. So he's not going to be intimidated by anybody. He's a nice guy apparently, but he's not a jerk.
Well, I was
but
more
he's-
supporting your argument about Alan Greenspan. That makes a lot of sense, that like he kind of just dominated.
Yeah, but we do have dissents, and it's interesting. You can read the minutes of the meeting after the fact, and you can go in there and you can say, well, so for instance, Mr. Kaplan's predecessor, Richard Fisher, was a big dissenter, and you could see in the minutes where he said, no, I think you're wrong. We need to be more aggressive or less aggressive, depending on his
And I
position.
think part of the concern there is just what it does to the markets.
Well, certainly that there's the potential to move the markets in response to this. So this is a big overview of the Fed, the stuff that I really want you to understand. Couple of things about it that are somewhere between fun facts and useful things to know. The district lines have been set since 1913. So if you go back to my map, you see that clearly if we were going to reapportion Federal Reserve districts, we wouldn't do it like this, right? We wouldn't have one bank in for the entire West. I'm sure we have an LA branch, a San Francisco Federal Reserve, and probably a Dallas or a Denver Federal Reserve as well. But 103 years ago, the West wasn't all that important financially, and what was out there was mostly centered in San Francisco. So you see that. We've already made the point that the New York Fed is probably the most important of the districts because it's where the financial center is. If you ever want to win a bar bet, there is only one state in the U.S. that has two Federal Reserve banks domiciled in there, right? You probably saw in your notes. But I guarantee no one, of course, if you're drinking with people who care about these things, it's probably not great. But the only state with two Federal Reserve banks is Missouri. The Kansas City Federal Reserve Bank is actually in Kansas City, Missouri, and not in Kansas City, Kansas. Nothing is in Kansas City. So there you go. All right, let's see. What else do I have? Yeah, and that's obviously to support the Cardinals, but we all knew that. Okay, I'm going to, let me make these last points real quick and then I'll give you a break. The most important way the Fed can influence the money supply is by open market operations. However, they can also have an influence by altering reserve requirements and by lending directly to commercial banks. Now, that doesn't happen very often, that the Federal Reserve changes minimum reserve requirements, so we can kind of put that one off to the side. Open market operations and compared to discount lending is something you do need to understand. So let me just end this discussion of the Fed by, I don't know, reminding you of something or telling you something you didn't know. When banks need liquidity, when they need to borrow money, and if they need to borrow money for a short-term basis, I'm talking very short-term, often just overnight, there's two sources that a commercial bank can turn to look to borrow money. One thing that a commercial bank can do is go to what is the so-called Fed funds market. And if you pay attention to announcements from the Fed, you'll hear talk about the Fed funds rate. The Fed funds market is a market in which one commercial bank loans reserves, usually on an overnight basis, to another commercial bank. So that would be Park Cities Bank borrowing reserves from Texas-based branch of JP Morgan, that kind of thing. Okay? The rate at which the banks borrow and lend from each other, that's called the Fed funds rate. And it turns out the Federal Reserve has ways to control that interest rate. They can raise it or lower it. The other way that a commercial bank can borrow money is to borrow reserves directly from the Federal Reserve. So if I'm Park Cities Bank and I need to borrow a couple $1 million overnight, I can go to the Fed funds market, borrow it from another commercial bank, or I could go to the Federal Reserve in Dallas and I could borrow a couple $1 million then. That's referred to as discount lending or lending through the discount window. And the Federal Reserve can directly control the availability of loanable funds through the discount window, and they also control the interest rate that they charge. So that's just another mechanism that the Fed has to either inject or pull reserves out of the banking system.
So I work at the Federal Home Loan Bank of Dallas.
Yeah.
And we're a bank for banks as well.
Yeah.
We lend money, advances to our members as well. We're a low-cost source of funding.
Yep.
So how does that factor in as well?
Yeah, okay, so we could teach a whole class. In fact, at SMU we do teach a whole class in banking. In the US, things are a little bit more complicated than I've led on because we have some banks which are members of the Federal Reserve System, and then we've got other banks, probably your customers mostly, who are not members of the Federal Reserve System. So, give me an example of a bank that would borrow, or if you're allowed to, who would borrow or lend?
Comerica?
Yeah, Comerica. They probably are a Federal Reserve member.
FNC, first time.
Yeah,
All the small community guys.
yeah, the small community banks tend not to be officially members of the Federal Reserve System. So a small community bank typically will not be able to go to the Fed to borrow money. But that small community bank has correspondent relations with a bigger bank that is a member of the Federal Reserve.
Does that mean they're not FDIC insured?
No, that's different. FDIC insurance is available to any chartered commercial bank, including the community banks. So the insurance system, that's a great point because sometimes people confuse membership in the Fed with FDIC. Any commercial bank has access to insurance for their smaller deposits.
It's still 250,000?
It's still, yeah, 250,000. Unless it's changed, and I know. And there's ways for depositors to make it bigger, so you could maintain multiple accounts and stuff like that. Okay, I've dragged you guys on 5 minutes past break time. Don't leave with your exams, so bring them down, and let's do this. How many?